You are watching Market Watch, the brief overview of the key events from the world of finance. President Donald Trump's sweeping tax cut and spending bill has passed Congress, triggering alarm among bond market participants. According to the Congressional Budget Office, the legislation will add $3.4 trillion to the national debt over the next decade. This has driven yields higher. U.S. 10-year Treasuries have reached 4.34%, while 30-year yields climbed to 4.8%. While markets remain calm for now, investors are increasingly wary of the return of the so-called bond vigilantes, those who penalize governments for reckless fiscal policy. With political pressure mounting on the Federal Reserve and economic data weakening, the outlook for bonds remains uncertain, though the risk of a yield surge persists. The U.S. economy surprised again in June, adding 147,000 jobs as the unemployment rate unexpectedly fell to 4.1%. The strong labor data quickly dashed investor hopes for a near-term Fed rate cut. While the odds of a rate cut in July were recently at 25%, those expectations have now been pushed back. Despite signs of slowing in other indicators, the job market continues to underpin economic stability. The market reacted swiftly, the dollar strengthened, and short-term bond yields jumped. All eyes are now on the upcoming Fed meeting, which could be pivotal for rate policy going forward. With Trump's fiscal bill now law and trade tensions rising, gold is regaining strength. Spot prices have reached $3,329 per ounce, up 1.7% for the week. Though not an essential industrial metal, gold is increasingly seen by investors and governments as a hedge against fiscal disorder. Analysts also point out that growing debt pressure on the dollar could make gold even more attractive. If trade talks break down and Trump enforces new tariffs after July 9, gold could see a fresh upward push. Oil prices remain steady, with WTI trading around $67. However, uncertainty over global trade prospects is capping further gains. Washington is preparing to send letters detailing new tariff rates to dozens of countries, including the European Union and Japan, a move that casts doubt over future energy demand. Additional pressure comes from OPEC+, which plans to increase output by 411,000 barrels per day in August. Once again, geopolitics and U.S. fiscal policy are key forces shaping oil markets. That's all I have. Follow the news carefully and be prepared for all the surprises of the market.